Picture this. You just bought a brand new car, and you're feeling good cruising down the road. Fast forward a few weeks, and bam, an accident. The car's totaled. You call your insurance company thinking you're covered. But then they say, we'll pay you the actual cash value. And guess what? That's way less than what you still owe on your auto loan. Yup. You're stuck paying thousands for a car you can't even drive anymore. That's where gap insurance comes in. So, what exactly is gap insurance? And why do so many car owners not even know they need it? Stick around for a few minutes, and I'll break it down in the simplest way possible. Because this one coverage could save you from a financial disaster. Let's start with the name. GAP stands for Guaranteed Asset Protection. But what it really does is cover the gap between what your car is worth and what you still owe on it. Sounds boring? Let's make it real. Say you buy a new car for $35,000. You finance it, meaning you're making monthly payments. A few months later, the car gets totaled in an accident. The insurance company says your car's actual value at the time of the crash is $29,000, but you still owe $33,000 on your loan. That's a $4,000 hole. Without gap insurance, you pay that gap out of pocket. With gap insurance, it pays the difference. Simple as that. Now you might be thinking, well, I have full coverage, I should be good, right? Not quite. Full coverage means your policy includes liability, collision, and comprehensive. But even that only covers what the car is worth today, not what you paid for it. And cars lose value the moment you drive them off the lot. In fact, most new cars drop by 20% to 30% in value in the first year alone. So, if you financed your car with a low down payment or a long-term loan, there's a high chance you're upside down on your loan, meaning you owe more than the car's worth. And that's where gap insurance is a financial lifesaver. But wait, it gets better. Gap insurance doesn't just help if your car is totaled in a crash. It also applies if your car is stolen and not recovered. Same story. Your insurer pays the actual value, and gap insurance covers the rest of what you owe. Now, let's talk about who actually needs it. If you're leasing a car, guess what? Gap insurance is often required by the lender. If you're buying a new car with little or no down payment, or stretching your loan over 60, 72, even 84 months, gap insurance is strongly recommended. Basically, if there's a decent chance you owe more on your car than it's worth, gap insurance should be in your policy. How much does it cost? Here's the good news. It's super affordable. If you buy it through your car dealership, it might cost a few $100s up front. But if you add it to your existing car insurance policy, it could cost as little as $20 to $40 per year. Yep, that's it. Just be careful. Dealers often charge way more than insurance companies. Always compare before adding it to your loan. Also, you can only get gap insurance on new or recently financed cars, and only for a certain period, usually until your loan balance drops below the car's actual cash value. Once that happens, the gap is gone, and you can drop the coverage. Still wondering if it's worth it? Let's do the math. A few extra bucks a month could save you thousands if disaster strikes early in your car's life. It's like a small umbrella that protects you from a sudden storm of debt. And here's the deal. No one plans to total their car. But accidents, theft, and bad luck happen every day. Gap insurance is that silent hero in your policy that shows up only when you need it most. So here's the bottom line. If you're financing or leasing a new car, don't just stop at full coverage. Consider gap insurance your safety net, because the only thing worse than losing your car is still having to pay for it afterward. If this helped you understand gap insurance better, hit that subscribe button now.